It is the final trading session of the week. We see stocks down about 1% amid geopolitical events transpiring overnight here at the open. And of course, it has still been a very busy week with all sorts of economic data ahead of that Fed decision next week. Joining me now with more on the markets is Lloyd, is the CEO and president at Lloyd Financial Group. Luke, it's good to have you on the show this morning, joining us remotely. Thank you so much. And what is top of mind for you as we kick off this final trading session of the week?
Yeah, I think we have to look at all the data that came out this week. The weakening CPI report we saw 2 days ago, the weakening PPI report we saw yesterday. Of course, with oil prices skyrocketing overnight, inflation kind of conversation comes back into the equation. But it's very interesting that, the talks the past couple of months, the talk on the street was, these tariffs were going to be so inflationary. Well, we're not seeing essentially any impact yet. Or if we are, the downturn, maybe the economic side of things, whether it's the job market or consumer spending, that's offsetting the inflationary pressure of the tariffs. So when I'm talking to clients and when I'm kind of going for my clients from a positioning standpoint, is I'm really focusing on the utilities, longer duration stocks, dividend payers. I think that the Fed rate cutting cycle is actually going to be expedited because of some of the data this week. And what I find interesting is, the Federal Reserve was so late to the game on the rate hiking side back in 2021, 2022. I think they're late to the game on the cutting side, so they're going to have to make up, which might mean even more rate cuts than projected, maybe for next year as we head into this year. So I think those rate-sensitive stocks and names you have to pay attention to and start looking to buy.
Yeah, look, a lot of folks are expecting rate cuts at some point this year, Luke, at least on the horizon. So we are going to hear from the Fed Chair Jerome Powell next week. Is there a timeline that you anticipate these rate cuts will come, given the latest data?
Well, there were 3 priced in before the data came out this week. I think that number might be 4 or even 5. It all depends on the labor market. We saw the claims come in yesterday a little bit higher than expected, the jobless claims. I think it's actually the highest it's been since late 2023, I think August of 2023. So if we see the unemployment rise, it's going to give them a lot of power and a lot of say that we should be cutting rates and we need to actually lower the Fed funds rate to adjust for the economy. The middle class America cannot afford 7% mortgages. This whole entire Ponzi scheme of debt can't be refinanced at higher interest rates when it comes to the federal debt. Also, I think 50% of federal debt comes due in the next couple of years. So I think really one of the reasons Scott Bessent is even in the administration is to get the 10-year Treasury. And we saw that happen early this year. I think the 10-year dropped to 3.7. We saw that get back closer to 5. I think the 10-year Treasury note is going to get back to 3.7%, which is one of the reasons why those small mid-cap companies, the RSP equal weight index, I think will actually outperform the cap weighted index, because most people think that technology, these large tech stocks, actually do better in a low rate environment. Well, it doesn't do as well as actually the smaller names. Those large cap companies have $500 billion in cash. They have so much cash on the sidelines that they're earning interest on these higher rates. It's actually adding dollars to the bottom line. So it actually benefits the smaller companies more, which is why we're paying attention to the equal weight index. And I think as we head into this year, equal weight will outperform.
Luke, I do want to ask you about the geopolitical events that unfolded overnight and the reaction that we see here on Wall Street today, with the major indexes down about 1%, oil about 8% higher in the wake of these events. What do our viewers need to know?
Yeah, I think the viewers need to know that and look at the DXY, the dollar index. Take a look the past 3 years. The DXY dollar index is the lowest it's been in 3 years. And even with some of these geopolitical events, it doesn't seem like the dollar is really gaining that much strength. A weaker dollar actually benefits international countries. So yeah, we can talk about oil, we can talk about natural gas. I do believe natural gas is a good investment when it comes to maybe these geopolitical events. Outside of even the geopolitical events, the fact that we're going through this AI revolution, the huge energy demand. My clients own LNG. I think a lot of people need to look into natural gas. But from an international standpoint, asset allocation standpoint, you saw this year how much internationals outperform the U.S. markets. I think that trend continues. Look at India, look at Mexico, look at Argentina, look at South Africa, look at South Korea. All these places are going to be actually benefiting from these global rising tensions, especially with the China-U.S. trade relations. I'm not in the camp that these trade relations get figured out very soon. All we've heard the past 2 months is a lot of good news around the U.S.-China relations. I don't think that the China's going to play nice. They haven't played nice before. And when you take a look at the international stage, China's actually in a weaker spot than the United States when it comes to the economic side. And if you're in a weaker spot and #2 nation in the world, do you help the #1 nation get ahead even more, or do you try to bring them down with you? Something we all need to think about. So as we unplug from China, all those other countries are going to benefit from moving the supply chain. I think we should look international, and it has been a story of international this year so far.
Luke Lloyd, CM President at Lloyd Financial Group. Luke, thank you so much for joining from Kentucky.
Thanks,
Great to see you.